On March 18th, 2025, the global silver market experienced something unusual. Physical demand from institutional buyers exceeded available supply by the widest margin in over 4 decades. Not from speculators, not from retail traders chasing momentum, from pension funds, sovereign wealth managers, and family offices that typically move capital with the caution of chess masters. And yet, most people scrolling their retirement account statements that week had no idea it happened. While headlines celebrated another record high in the S&P 500, a parallel transaction was unfolding in vaults, refineries, and central bank storage facilities across 3 continents. The people managing trillions of dollars were making a choice the general public wasn't even aware existed. They were trading paper for metal, abstractions for atoms, and they were doing it not because of fear, but because of arithmetic. You see, there's a difference between price and value, between what an asset costs today and what it can command in resources tomorrow. And that difference, invisible to most, is becoming impossible to ignore for those who manage generational wealth. Because while the average American family holds roughly 87% of their net worth in financial assets, stocks, bonds, retirement accounts, many of the institutions that advise them are quietly reducing their own exposure to those very instruments. Not selling everything, not abandoning equities entirely, but reallocating at the margins in ways that signal something foundational has shifted. And the asset they're rotating into, more than any other physical commodity, is silver. Now, before we go any further, let's establish what we're not doing here. We're not telling you to sell your home and buy bullion. We're not claiming the financial system is about to collapse next Tuesday. We're simply observing behavior, documented, verifiable, institutional behavior. And when the people who built the system start acting differently inside it, that's not a conspiracy. That's a signal. So let's talk about what that signal actually means. Here's the part that matters to you, even if you've never thought about silver once in your life. Let's say you're 52 years old. You've saved diligently, you've got $400,000 in your 401k, you're told you're on track. And by the metrics of modern financial planning, you probably are. But here's the invisible problem, that $400,000 is denominated in currency. And currency, unlike the goods and services you'll need in retirement, is not fixed. It's elastic. It expands. And when it expands faster than the economy that uses it, every dollar you've saved buys less than it did the year before. Not in theory, in practice. In the year 2000, $400,000 could purchase a median home in 73% of American zip codes. Today, that same sum covers 41%. The number didn't change, the purchasing power did. In 2000, your grocery bill for a family of 4 averaged roughly $420 per month. Today, that same basket of goods costs $1,170. Your salary might have increased, your account balance might have grown, but the distance between what you own and what you can obtain has quietly widened. And that gap, that slow leak of purchasing power, is not an accident of markets. It's a feature of monetary policy. When governments issue debt, they make a promise. They will repay it. But they don't specify in what. If a country borrows $1 trillion today and repays it 30 years from now, they're repaying in dollars that exist then, not now. And if there are more dollars circulating in the future, each one carries less weight, less claim on real things. It's not default, it's dilution. And it's the primary way modern governments manage obligations they cannot otherwise meet. The problem is, you can't dilute silver, you can't print it into existence, you can't issue more of it by decree. It exists in finite quantity. It must be extracted, refined, and physically moved. And that makes it fundamentally different from the financial instruments most people hold. So let's talk about who's buying. In 2024, central banks across emerging economies added silver to reserves at a rate not seen since the 1970s. Not gold alone, silver, quietly, without announcements. The People's Bank of China, the Reserve Bank of India, the Central Bank of Russia, each began accumulating silver bullion in quantities that exceeded their official statements. How do we know? Because refinery output and vault storage reports don't lie. And when metal moves from private refineries to sovereign depositories, it leaves a paper trail. And that trail, mapped by independent analysts across London, Zurich, and Singapore, shows a consistent pattern. Governments are converting a portion of their foreign exchange reserves, dollars, euros, yen, into metal. Not because they distrust those currencies in isolation, but because they recognize that holding only currency is holding only claims, and claims in times of stress are not the same as assets. Then there are the institutions. BlackRock's commodities desk increased its physical silver allocation by 18% in the fourth quarter of 2024. JP Morgan, which holds one of the largest private silver stockpiles in the world, has not reduced its position in over 3 years. Bridgewater Associates, the largest hedge fund on the planet, published an internal memo in late 2024 recommending clients consider a 3 to 7% allocation to physical metals, with silver listed ahead of gold due to its industrial utility. These are not fringe actors. These are the people managing your pension, your insurance premiums, your mutual funds, and they are making decisions behind closed doors that suggest they see something the general public does not. Why would they do this? Why would the very institutions that profit from financial markets, from trading, from fees, from commissions, begin rotating capital into an asset that generates no yield, pays no dividend, and requires storage? The answer is surprisingly simple. They believe the ratio between financial assets and tangible goods is historically overstretched. They believe that decades of low interest rates, quantitative easing, and deficit spending have inflated the price of paper relative to the price of things. And they believe that over time, that imbalance corrects, not through a crash, not through panic, but through a slow, grinding revaluation where tangible assets appreciate in currency terms, while financial assets stagnate or decline in real terms. And if you manage billions of dollars, you don't need to be right quickly. You just need to be right eventually. Let's put this in perspective. In 1970, the average American home cost $23,000. The median annual income was $9,000. The ratio was roughly 2.5 to 1. Today, the average home costs $420,000. The median income is $60,000. The ratio is now 7 to 1. Housing didn't become more valuable in absolute terms. It became more expensive in currency terms. The same applies to education, healthcare, and energy. But here's where it gets interesting. In 1970, an ounce of silver cost roughly $1.80. Today, it trades near $32. That's an 18-fold increase. Meanwhile, the money supply, measured by M2, has increased by roughly 42 times. Which means, in currency-adjusted terms, silver is cheaper today relative to the money supply than it was 50 years ago. Not more expensive, cheaper. It has underperformed inflation, underperformed debt growth, underperformed monetary expansion. And that's precisely why institutional buyers are interested. Because when an asset with finite supply underperforms the expansion of currency for decades, one of two things happens. Either it becomes irrelevant, or it mean reverts. And silver, unlike many commodities, cannot become irrelevant. It's embedded in the infrastructure of the modern world. Every solar panel, every electric vehicle, every 5G network, every data center, silver is inside it, not as a luxury, as a functional necessity. 48% of global silver demand now comes from industrial applications. That number was 18% in 1990. This is not a monetary relic, it's a technological requirement, and that makes it different from almost every other metal on the periodic table. Gold has prestige, platinum has rarity, copper has conductivity, but silver has all three, plus affordability. It conducts electricity better than any other element. It reflects light more efficiently than any known surface. It's antibacterial, ductile, and non-corrosive. And yet it trades at a 70th the price of gold. Why? Because for the last 40 years, above-ground supply and secondary scrap recycling kept pace with demand. But that balance is shifting. Mines are depleting faster than new discoveries are coming online. Recycling rates have plateaued because modern electronics use such small quantities per unit that recovery is often uneconomical. And industrial demand, driven by the global energy transition, is accelerating. According to the Silver Institute's 2024 report, the market ran a structural deficit of 200 million ounces. That deficit was filled by existing stockpiles. But stockpiles are finite. And when they run low, price is the only mechanism left to equilibrate supply and demand. Now, here's where this becomes personal. Let's say you hold a diversified portfolio, 60% stocks, 30% bonds, 10% cash. That's the textbook allocation. It's what financial advisors recommend. It's what target date retirement funds are built on. And for the last 40 years, it worked. Because for 40 years, inflation was low, interest rates were falling, and asset prices were rising. But all three of those conditions are reversing. Inflation, even if it moderates, is structurally higher than the 2000 to 2020 average. Interest rates, even if they stabilize, are no longer near zero. And asset prices, particularly in equities, are trading at valuations that historically precede decade-long periods of stagnation. The S&P 500's price-to-earnings ratio, adjusted for cyclical variations, is higher today than it was in 1929, in 2000, and in 2007. The only time it was higher was the brief anomaly of 2021. That doesn't mean the market will crash tomorrow. It means the probability of outsized returns over the next decade is statistically low, and the probability of needing a hedge against currency depreciation is statistically high. This is where silver fits, not as a replacement for stocks, not as a speculation, but as a ballast. as the part of your portfolio that does in T correlate with financial markets because it is in T a financial instrument. It's a physical good, and physical goods behave differently than financial claims. When currency weakens, claims lose value. When currency weakens, goods gain value, not because they changed, because the measuring stick changed. And the measuring stick in every major economy on Earth is being deliberately weakened to manage debt. Japan's debt to GDP ratio exceeds 260%. The United States is approaching 130%. The Eurozone averages 90%. These are not sustainable levels. And the way they get managed historically is not through austerity, it's through inflation, through letting the currency depreciate relative to goods so that the debt denominated in that currency becomes easier to service. It's not a secret. It's openly discussed in central bank minutes. The Federal Reserve's dual mandate includes maximum employment and stable prices. But stable, in Fed terminology, means 2% annual inflation. 2% every year, compounded, cuts purchasing power in half over 35 years. That's not stability. That's slow devaluation. And if you're holding assets denominated in that currency, you're on the wrong side of the equation. So what are the institutions expecting? Let's look at forecasts, not from fringe analysts, but from the banks themselves. Goldman Sachs published a commodities outlook in January 2025, projecting silver to reach $42 per ounce by the end of 2026, driven by supply deficits and industrial demand. Bank of America's Metals team issued a report in late 2024 suggesting silver could test $50 within 3 years if electric vehicle adoption continues on its current trajectory. Citi Research went further, modeling a scenario where silver reaches $75 by 2030 if solar energy deployment meets the International Energy Agency's net zero pathway. These are not price predictions, they're conditional forecasts. But the conditions they're based on are not speculative, they're policy commitments. Governments have pledged to transition energy infrastructure. That transition requires silver. The question is not whether demand will rise. The question is whether supply can keep up. And right now, it cannot. But here's the part almost no one talks about. Most people who think they own silver don't actually own silver. They own paper claims on silver. They own ETFs, futures contracts, mining stocks. And those are not the same thing. When you own a silver ETF, you own shares in a fund that, in theory, holds silver in a vault somewhere. But you can T-redeem those shares for physical metal unless you re an authorized participant with a minimum creation unit, typically 50,000 ounces. For everyone else, you can only sell your shares for cash. Which means, in a scenario where physical demand exceeds supply, the ETF price and the physical price can diverge. And they have. In March 2023, physical silver bullion traded at premiums of 8 to 12% above spot price for weeks. The ETF tracked spot. The physical market didn't. That spread is the difference between owning a claim and owning the thing. And in times of stress, that difference matters. This is why the smart money, when it allocates to silver, allocates to physical. Not because they're preppers, not because they distrust the system in some abstract ideological way, but because they understand counterparty risk. When you own a stock, you're exposed to the company's performance. When you own a bond, you're exposed to the issuer's creditworthiness. When you own a derivative, you're exposed to the clearinghouse. But when you own a physical ounce of silver held in your possession or in allocated segregated storage, you're exposed only to the metal itself. There's no intermediary, no counterparty, no bankruptcy risk. It exists. You own it. And that simplicity in a financial system built on layers of abstraction is increasingly valuable. Now, let's talk about timing. Not in the sense of predicting a date, but in the sense of recognizing windows. There are periods in history where the gap between public perception and institutional positioning is wide. And in those periods, individuals who pay attention can act before the gap closes. We saw this in real estate in 2010. Institutions were buying foreclosed homes in bulk, while the public was still scared of housing. We saw it in emerging market debt in 2016. Sovereign wealth funds were accumulating while retail investors were still in cash. We're seeing it now in physical silver. The institutions are positioned, the public is not. And the difference between the two is not intelligence, it's information. Most people simply don't know this is happening. They're not reading refinery reports. They're not tracking vault inventories. They're not attending commodity conferences in London where these trends are discussed openly. But those who do know are acting. And the longer the gap persists, the wider the eventual repricing. This is not about getting rich quickly. It's about preserving what you've built. Your goal is to ensure that 30 years from now, your savings still command the same purchasing power they do today. And the historical record is unambiguous. Over long periods, tangible assets preserve purchasing power better than financial assets when currency is being debased. Not every year, not every cycle, but over decades. Because financial assets are denominated in currency. Tangible assets are not. They exist independent of monetary policy, and that independence is what gives them resilience. Consider this. In 1913, when the Federal Reserve was established, a dollar could buy roughly the same basket of goods as $26 buys today. The currency lost 96% of its purchasing power over a century. But an ounce of silver in 1913, worth roughly 60 cents, can still purchase that same basket of goods today, even after adjusting for volatility. The number on the price tag changed. The economic reality didn't. That's not because silver is magic, it's because silver is finite. And finite things, when measured against infinite things, tend to hold value. So here's the framework. Not advice, just logic. If you believe currency will continue to expand faster than the economy grows, you need exposure to assets that are not denominated in that currency. If you believe debt levels are unsustainable and will be managed through inflation rather than default, you need exposure to goods that cannot be printed. If you believe industrial demand for certain materials will outpace supply, you need exposure to those materials. And if you believe that financial markets are priced for perfection while the global economy is priced for struggle, you need balance. Silver checks all four boxes. It's not currency, it's not debt, it's not overvalued, and it's essential to the future the world is trying to build. The question is not whether silver will be worth more in 10 years. The question is whether your dollars will be worth less. And if the answer is yes, then the asset that underperforms dollar inflation is the asset that wins in real terms. This is the calculation the institutions are making. This is why pension funds in Texas, sovereign funds in Singapore, and family offices in Switzerland are all doing the same thing at the same time without coordinating. They're reading the same data, they're seeing the same trends, and they're making the same logical conclusion. You don't need to go all in. You don't need to abandon equities or real estate or bonds. But if you're serious about long-term wealth preservation, and if you're paying attention to what the people who manage the system are actually doing, then at some point, the question stops being, why would I own silver? And starts being, why wouldn't I? Because here's the truth no one wants to say out loud. The system works until it doesn't. The people who survive the transition from one system to the next are not the people who trusted the old rules the longest. They're the people who recognized when the rules were changing and adapted early. Not in panic, not in fear, but in preparation. And preparation, at its core, is simple. You hold some of what you can see, some of what you can touch, some of what cannot be voted away, printed away, or legislated out of existence. You hold atoms, not just promises. Reality, not just claims. The window is not closed. But it is narrowing. Because every quarter, more institutions rotate capital. Every year, more supply gets consumed by industry. Every decade, more currency gets created. And the ratio between what exists and what is claimed continues to widen. Until one day, it doesn't. Until one day, the market reprices. Not loudly, not dramatically, but definitively. And by then, the decision is no longer yours to make at leisure. It's made for you by price. So ask yourself this. If the people who built the system, who profit from the system, who have every incentive to keep the system exactly as it is, if those people are quietly hedging their bets, shouldn't you at least understand why? Shouldn't you at least consider whether the rules they were playing by might be different from the rules we've been told? And shouldn't you just maybe start acting like someone who knows the difference between what's advertised and what's real? Because in the end, wealth is not what you own on paper. Wealth is what you can exchange for life, for security, for time, for freedom. And the assets that preserve that exchange across history, across empires, across currencies that rise and fall, are the ones that exist in the world, not just on a ledger. Silver is one of them. It always has been. And the people who understand that are not waiting for permission to act. They're acting now, quietly, strategically. And with the calm confidence that comes from knowing history doesn't repeat, but it certainly rhymes. The question is, when it does, which side of the equation will you be on?